Hey everybody, welcome to another episode of Green Spud Trades. In this episode, we're going to be taking a look at the aerospace parts industry with a focus on a really interesting company called Loar Group. Loar Group is an aircraft parts manufacturer that makes small components used throughout an aircraft. This infographic from their most recent 10K filing shows you some of the parts that they make. The company was started in 2012. Here's the guy who started the company, Dirksen Charles. It looks like he started out in accounting and then got into the aircraft parts field and then went off to start his own aircraft parts holding company. They IPO'd in 2024. In those 12 years between, the company was owned by its founders and a few venture capital firms. They used their private capital to acquire a portfolio of small, niche aerospace manufacturing companies. The world of aerospace supply chains is surprisingly fragmented, and Loar is trying to consolidate some of it under its umbrella. A thing that makes Loar unique is that they have a diversified customer base and product portfolio, but also the parts they manufacture are hard to replace with alternatives from other suppliers because most of those parts provide very specialized functionality, and Loar also owns the patents for them. According to their investor releases, 89% of their product portfolio is proprietary. They also benefit from being an OEM supplier for new aircraft and also selling the same parts aftermarket for when they need to be replaced on aircraft currently in service. About 55% of their sales are for aftermarket parts. In addition to a wide moat when it comes to their position in the market, the entire aircraft parts industry has a strong tailwind. According to the International Air Transport Association, we currently have a rapidly aging fleet of commercial aircraft, driven by a shortfall in new aircraft deliveries. The major aircraft manufacturing companies just can't keep up with demand. A part of this is caused by the industry still recovering from the slowdown in manufacturing during the COVID crisis. Boeing currently has about 6,000 aircraft on backorder, and the backlog keeps growing. There's also a tailwind for the aircraft parts industry when it comes to the ever-increasing military spending by the government. Included in those huge budgets is a need for new aircraft and replacement parts from their heavy use. So let's take a look at how this all translates to top and bottom line results for Loar Group. This last quarter had some impressive levels of growth. 23% revenue growth and 21% operating margin growth for the year 2025. 52% gross margin. The earnings per share jumped a whopping 212%, but that was largely driven by a decrease in interest expense. The company used some of their IPO cash to pay down debt, and the interest expense gains are expected to reverse in 2026 after taking on some additional new debt to fund new acquisitions. They have a strong free cash flow of $100 million, and despite all the acquisitions, the debt-to-equity ratio is still a manageable 0.61. So, this begs the question, given all of these positive fundamentals, why does the stock performance suck so bad?
Bruh.
Well, there seems to be two major things holding the stock back. One of them is a lofty valuation. Right now it has a 75 forward PE ratio for 2026. But since earnings can be volatile due to the financing effects of their acquisitions, let's take a look at their enterprise value to EBITDA ratio. That should help back out the impact of their financing choices to give us a better comparison against their peers. At the current stock price, Loar's 2025 enterprise value to EBITDA of 35 seems to be in line with its peers. Loar is also a lot smaller than the other publicly traded companies that operate in this sector. It's got a lot of room to grow that $500 million in revenue. The 2026 guidance issued with the Q4 2025 release may have seemed soft. On the conference call, though, management explained that the higher expenses are related to two acquisitions made in the fourth quarter, some of which will be interest expense related to debt, but a sizable portion of that will be one-time accounting adjustments to amortize intangible assets that were acquired. The other problem for this stock is equity dilution. In December of 2024, just 6 months after their initial public offering, the company raised another 3.8 million shares, adding to their 92 million share count at the time. And then in May of 2025, the company filed a shelf registration with the SEC, allowing some of the insiders and venture capital firms to sell their stock. Soon after the filing, the company issued a press release announcing a secondary public offering of 9 million of those shares at a price of $83.41. Even though this offering did not add to the total share count, it did add to the number of shares in public circulation. Looking at the stock chart, this event seems to have marked the peak in the stock price. The additional liquidity is probably much to do with why the stock has been going down. But it's not all bad news for this stock. In recent months, some insiders have been buying. Analysts also seem to love this stock. Currently, all analysts covering it rated a buy. On average, these analysts seem to like it better than its peers among the group. It was also recently placed on the Goldman Sachs conviction buy list. The kind of price action that I would be looking for in this stock to know that it's turning around is at one, it's got to kind of reverse this sort of inverse parabolic that it has going on here. But this actually might be a really good time to buy. It's approaching a very negative RSI right now. So a good buying opportunity might be coming up soon once it dips down here and reverses. You get a nice thick bar down there. It breaks out. And then hopefully it also gets above this little volume pocket right there. And then I think that would be a sign that the stock price is turning around. But then for a longer term setup, you have this resistance zone up here. And then once it breaks above 100, then that's probably a really positive sign. But I think the earnings will probably have to catch up to the valuation a little bit for it to get there. So this concludes my brief analysis of the stock. Overall, I like it, but I think the biggest risk is if they continue to make acquisitions and they can't get great prices for them and maybe run up too much debt or dilute the equity some more. But so far, the debt seems to be relatively well managed, and hopefully they're done diluting equity for now. I'd love to hear what you think. So go ahead and write a comment below. Don't forget to hit the like button. And if you like this video, check out some of my other stock analysis videos. See you next time.